Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited to discuss your former employer 401k is costing you big. Roll over to your solo 401k and keep more. If you have questions or topics that you wish to discuss, whether on this topic or a related topic, or even unrelated topic, please chat it over as we'll go through your questions and topics. We'll actually start out with the question that was already chatted over. But go ahead and chat those over as we go through the slides. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we'll start it out with the first question that was chatted over here. Does my solo 401k document allow for the roll of 55? My wife will stay employed by the business in the limited role so we can keep the 401k trust account open as well as the business. So while it is theoretically possible to take advantage of the roll of 55, really the rule of 55, it's almost never done because usually that means the person would need to shut down their self-employed business. The exception would really be in the scenario that's described here, where, so for example, the individual who's 55 will in fact retire, but the business will continue because it's going to continue to be operated by the spouse. So yes, it can be done within those, if you can actually satisfy the requirements. Yes, it can be accommodated. Good question. All right, so now let's go through the slides that we wanted to bring and share. So we're going to discuss why your old 401k might be a money pit, the power of the solo 401k, how to save thousands by rolling over to a solo 401k. We'll touch on the process, and then again, any Q&A, whether on this topic or any other topics you want to discuss. So your old 401k, a hidden cost center? Well, this is because the fees, right? These might be administrative fees, which sometimes the fees will go up for employees after they leave because your employer may be covering the fees or subsidizing the fees while you're an employee. But once you stop being an employee, that subsidization may go away. Investment fees, right? The investments that are available under your old former employer plan, they may be limited. They may have high cost funds, right? There may be one-off fees like charges for withdrawals. So these are all things to consider and that many folks are not aware of when they leave a job and leave their old 401k behind. So there have been a number of research or studies that have been done, which we did some research around that and summarize this here in a slide where we talk about this is where the thousands disappear. So for example, a study talked about how even a fee as little as $4.55 a month over 30 years could result in a loss of over $18,000 less in your retirement account. A 1% fee difference could amount to 28 to 30% less over time. So not only, and why is that? Not only does the monthly fee eat into the principal, but the participants also lose the compound growth that would have accumulated on the balance. So the sources are listed there at the bottom of the slide. So that's why some folks will be eager to roll over their former employer plan to a solo 401k. Now they're going to have to be eligible to set up a solo 401k. In order to set up a solo 401k, generally you have to be self-employed, meaning you're reporting earned self-employment income with no non-owner, non-spouse, full-time W-2 employees. And a solo 401k from my solo 401k Financial is the most powerful solo 401k that's available because we have set up our plan to include all the features that might be available for a solo 401k. So for example, a solo 401k has the highest contribution limit. So that it has the highest contribution limits for any defined contribution plan available to self-employed individuals. For 2025, for example, a self-employed person could contribute up to $70,000 or even more if they're age 50 or older, assuming they have the self-employment income to justify those contributions. Again, if they go with the powerful solo 401k offered by my Solo 401k Financial, it's going to include all the options that are available under the rules. So that's going to allow for not only pre-tax contributions, which reduce the taxable income now for the year for which you make the contribution, but also Roth and or mega backdoor Roth contributions, which allow for tax-free growth. Full investment freedom. So what we mean by that is that our plan not only allows for typical brokerage type investments, but also true alternative investments, right? So you get the full complement of brokerage investments, whether it's stocks, bonds, mutual funds, ETFs, but also real estate, crypto, private placements, notes, right? The other true alternative investments that are available under our plan. It also allows for a loans. So it's got the ability to take 401k participant loans. So ultimately you're in control. So it's a big contrast with leaving money in a former employer plan. So you first have to be eligible, then you can access a solo 401k generally. You could also access the most powerful solo 401k, which is the one offered by my Solo 401k Financial. And then you can roll money over from the former employer plan to the solo 401k, right? So that's going to, for many folks that have high fees in their former employer plan, for the reasons identified in the research and the studies that are a part of that research, but also now gives you access to all the features of the Solo 401k offered by my Solo 401k Financial. So not only you could use that money to then take a 401k loan, you could use that money to invest in a wide range of brokerage type investments or even alternative investments. In terms of the fees specifically, our fees are capped. It's a totally flat fee, regardless of the value of your plan, regardless of what you're investing in, right? We're going to just charge $125 a year. Moreover, we're totally neutral as far as where the accounts are opened up at. So a typical scenario would be a customer would want to open up an account at a brokerage like Fidelity or Schwab. Well, Fidelity and Schwab, they do offer their own basic solo 401k plans, but they don't offer the powerful solo 401k plan offered by my Solo 401k Financial. In other words, their features of their plan are vanilla, whereas our features are much more extensive. But at the same time, those brokerage firms will open up accounts for third-party plans. So you can have the fully featured plan provided by us, but still have your accounts where you want them, like Fidelity and Schwab. So the type of accounts that Fidelity and Schwab open up for third-party plans, they don't charge fees for those accounts in terms of there's no fees to open or maintain the account. They also offer free trading. They offer the ability to invest in publicly traded stocks, mutual funds, ETFs, etc. So that's how some clients will be able to control the fees, right? Especially compared to leaving the money in the former employer plan, where it might be subject to the higher fees that were discussed up above. And then on top of that, from a fee perspective, what's great about our plan is that it makes the self-employed business eligible to claim $1,500 in solo 401k tax credits. So that's $500 per year for 3 consecutive years. So effectively, that's going to cover our fees for more than the first 7 years. In other words, our fees over the first 7 years don't even amount to $1,500. So for someone who's really looking to control the costs, that can be a powerful option. So is a solo 401k right for you? Ultimately, of course, that's a discussion. With you and your tax advisors. But in terms of eligibility, you need to be eligible, right? You have to be self-employed, reporting earned self-employment income, no full-time W-2 employees other than the self-employed person themselves or their spouse. You need to report that earned self-employment income. So that could be income reported on Schedule C. In the case of a business, tax as a sole proprietorship. W-2 wages, in the case of a business, tax as an S Corp or a C Corp. income reported on a K-1, like line 14 of a K-1 for a business tax as a partnership. In terms of the process, let's touch on the process and then we'll circle back to the good questions that are being chatted up. Thank you for bringing the questions. So as you might imagine, we've helped customers roll over money from hundreds of different places. And a lot of times those places will each have their own unique process, right? It might be an online process, might be a phone process, might be a paper process. So over the years, right, we've been in business since 2009, helped thousands and thousands of customers. We've tracked that experience, right, to make it easy for new customers or existing customers that are going through the rollover process now. So we will typically ask for a recent account statement so we can map out the process for you, leverage that knowledge base, right, to make it easy. But ultimately, the goal is for the money to transfer as a direct rollover, because that way it's non-taxable. It is reportable. So the former employer plan administrator will need to tell the IRS that you transferred the money. That's why it's good to work with us, so we can help make sure that the process is followed so that they understand that you're not just taking a taxable distribution, but instead you're doing a direct rollover, so that then they report it to the IRS as a non-taxable direct rollover. Sometimes folks will say, well, just do an indirect rollover. The problem with that is that it's got a number of compliance pitfalls. So an indirect rollover is when someone just withdraws the money from the retirement account and then they deposit it into the new retirement account within 60 days. Well, there's no extension on that 60-day deadline. That's a hard deadline. So if the person misses the deadline, now they've taken a taxable distribution. Moreover, typically when you withdraw money as a taxable distribution from your former employer plan, they're going to withhold 20%. So if you take a $10,000 distribution, they're going to send $2,000. They're going to withhold it and send $2,000 to the IRS. They're only going to give you $8,000. So if you want to process an indirect rollover, you have to deposit the money within 60 days, but you got to deposit the entire money, the full $2,000. So now you got to come up, the full $10,000. So that means you got to come up with an additional $2,000. In other words, the amount that was withheld, then circle back to the IRS to claim a refund, which is obviously not ideal, right? To essentially give an interest-free loan to the IRS. So that's why it's much better to process it as a direct rollover. And that's part of the service we provide, is to help you with that direct rollover, to roll it over to your solo 401k. Ultimately, to get started, it's very easy. It's just a 1-minute application. Go to mysolo401k.net, click on open account, and solo 401k. We prepare the plan documents within the same business day. We host these daily webinars. If you're finding this to be helpful, please like this video. It helps us to get the word out to other solopreneurs, other self-employed individuals just like you, whatever platform you're on. Please like the video. Please share with others that might find it to be helpful. Feel free to book a call at mysolo401k.net/book. Please subscribe as well. That way you get notifications of when we go live. We go live on a daily basis. So that way you can jump on, ask questions. We like to share content, but also have Q&A discussions. So we appreciate the good questions. All right, so let's go through some questions. What are the advantages of rolling over from my after-tax solo 401k to a Roth 401k versus to a Roth IRA? That's a great question, and we've done some webinars about that recently, but I appreciate you bringing the good question. So a lot of times it comes down to, what does the individual want to do with the money? So if they want to invest in alternative investments, well, keeping the money in the solo 401k by transferring it to a Roth solo 401k is going to allow them to invest in alternative investments, whether it's real estate, crypto, private placements, etc. Do they want to maybe take a loan or think that they might in the future? Keeping it in the solo 401k would be another good reason, because now they could use that Roth solo 401k money as a 401k participant loan. In other words, they could borrow from their self. They could borrow from their 401k, lend it to themselves as a solo 401k loan. You can't take a loan from a Roth IRA, right? The Roth IRA rules don't allow it. It's hard to invest in alternative investments, relatively speaking, via a Roth IRA. For example, it would have to go to a specialty Roth IRA provider. They're going to hold the money, so you won't have the checkbook control. If it's in a self-directed Roth IRA, they're typically going to have their own fee schedule, etc. So depending on what the person wants to do with the money, that will oftentimes dictate where they transfer the money to. Now, some folks will say, well, I'm not interested in a 401k loan. I'm not interested in alternative investments. I have a Roth IRA. Maybe it's managed by my advisor, which I'm pleased with the performance, and I want to continue to accumulate money in that Roth IRA. Well, that would be a reason to transfer it to a Roth IRA. Another reason is someone might say, well, I think that I might want to withdraw some of the contributions, some of the basis. So the rules around withdrawals from Roth accounts differ. If it's an early withdrawal, they differ when it comes to a Roth 401k versus a Roth IRA. So if you take an early distribution from a Roth 401k, you're going to have to take out some of the basis, some of the contributions that you made to the account, along with some of the gains, right? Some of the additional money that accrued while the money was in that Roth 401k account, and then pay taxes on the gains. Whereas with a Roth IRA, you can take out just the basis, right? There, you have to consider the Roth IRA ordering rules. So you definitely want to work with your tax advisor. But in simple terms, it is possible to take out just the contribution amount and not the gains. So if someone is anticipating that, that would be a reason to maybe transfer to a Roth IRA. So those are some of the good considerations that you might want to factor in as you make that decision. So we are planning to transfer a previous 401k to a solo 401k. Are we able to pay the initial cost using 401k funds? Great question. The answer is no. You cannot use retirement money to pay to set up the plan. So our fee, which is $650, including the $525 establishment fee, plus the first $125 annual fee, would be paid with non-retirement money. If we open the solo 401k before transferring the old 401k, how can we use the 401k funds to pay for the initial cost? Well, we can't. You can't, per the prior answer. If I pay with personal funds, am I able to refund myself after the solo 401k is established? So the answer is no. You cannot use retirement money directly or indirectly to pay for that fee, to pay for the cost to set up the plan. Great questions. Thank you so much for bringing the good questions. We do appreciate it. If we open Schwab accounts to hold the funds, 401k and 401k Roth, do we need to establish the solo 401k to then open the Schwab accounts, then roll over the old 401k to the Schwab accounts? The answer is yes, because you first establish the plan, meaning the documents, then the documents are used to open up the accounts at the bank or brokerage of choice, like Schwab. Then the money's transferred to those accounts. Now, the transfer process and the account opening process can be at the same time. It can be parallel. It doesn't have to be sequential, because ultimately the funds are going to transfer by check, mailed to you, payable to the 401k. So while that check is being mailed, etc., you could be then at the same time opening up the accounts at Schwab, so that by the time you receive that check, you have an account into which to deposit it. All right, great questions. Thank you so much for the engagement. Please continue to engage. We invite you to our community. We've got over 30,000 members. We have a library of videos and webinars. Just email us at business@mysolo401k.net and we'll help you join. I've set up my solo 401k with you and already started making my employee contributions. Thank you so much. I was hoping to get an explanation on the basics of starting my employer contributions. I know it's different from the employee. Can you explain the options of how to get started with that? Most definitely. So Number one, the solo 401k does allow for multiple types of contributions. That's the reason that it has the highest contribution limits for any defined contribution plan available to self-employed individuals. Because in the words of the IRS, the self-employed person is both the employee and the employer. So you can make both employee as well as employer contributions. And then on top of that, our plan allows for voluntary after-tax contributions, which is how you make mega backdoor Roth contributions. Now, your ability to contribute, whether it's employee or employer or voluntary after-tax, depends on different factors. One is your age, one is your self-employment compensation, one is whether you make contributions to another plan, like a day job plan. So in the case of a business tax as an S Corp, self-employment compensation is the W-2 wages that the person receives from their self-employed business. So let's assume this individual has $100,000 of W-2 wages from their self-employed business, taxed as an S Corp. Let's assume they're under 50 years of age. Let's assume that they don't make contributions to another plan like a day job plan. So for 2025, they could contribute 100%, dollar for dollar of their W-2 wages as an employee contribution up to $23,500, right? So you can do 100% up to $23,500 as an employee. So that can be either deposited into a pre-tax solo 401k account or a Roth solo 401k account. Now, the employer contribution limit is 25% of the W-2 wages. So in this case, that'd be another $25,000. So those would be deposited into the pre-tax solo 401k. So if the individual first made $23,500 of pre-tax employee contributions into a pre-tax solo 401k sub account, and now they want to make another $25,000 of employer contributions, those will go into the same account. It is technically possible to make those employer contributions as Roth contributions, but based on experience and client feedback, most customers who want to, virtually all customers who want to make Roth contributions and really maximize the Roth contributions would choose to simply skip the making employer contributions and instead make those contributions simply as voluntary after-tax contributions. So here, that's why I'm assuming that you're going to want to make those employer contributions as pre-tax contributions. So in terms of the process, it's going to be 25% of the W-2 wages. It's going to be deposited into the pre-tax account. It could be the same pre-tax account into which the pre-tax employee contributions were deposited. The individual definitely wants to let their tax advisor know about those employer contributions so they can get the credit, right? Because it's going to be reported on the business tax return, the 1120S, as a deductible a deductible expense, that employer contribution for the year for which it is made. So hopefully that helps. Let me know if there's any questions, follow-up questions around that. In the meantime, let me grab a page on our website that sheds additional light. All right. Thank you so much for the good question. Take a look at that link. I chatted it over in the comments. Once established the solo 401k, are we able to pay the annual fees with solo 401k funds? Yes. There's a distinction under the rules between the cost to establish the plan and then the ongoing cost. The ongoing cost can be paid with retirement money. Now, most would choose not to do so because they want to preserve as much money as possible in their solo 401k, but yes, it is possible. Oh, I see the follow-up comment here. Thank you. I've set my W-2 income for the year at $40,000. Yes. So in that situation, let's assume the person made $23,500 as an employee, $10,000 as an employer. No, you wouldn't need to have separate brokerage accounts. They could go into that same pre-tax account. Where do we report the after-tax contributions if we already did the W-2? So voluntary after-tax contributions are a type of employee contribution, but they don't need to be reported on the W-2. If you look at the W-2 instructions, they talk about how voluntary after-tax contributions, it's optional to report those on the W-2. If you wanted to, it would go on box 14 per those W-2 instructions, but it's not required, it's optional. So what is required is the subsequent step. So when you make a mega backdoor Roth contribution, it's a two-step process. First, you deposit the money into a separate voluntary after-tax account. Then you move it either to a Roth solo 401k or Roth IRA. Per above, our discussion about those considerations about that move. Regardless of where it moves, it needs to be reported on a 1099-R. Now, we handle that as an optional free service. There's a form on our website that customers use to let us know the information we need to prepare the 1099-R. So as long as customers give us that information in a timely fashion, we'll prepare it as an optional free service. In other words, no additional charge. Well, great discussion. We appreciate the opportunity to discuss these topics. Please continue to engage. Like I mentioned, please like. It helps us get the word out, whether you're on X or YouTube or LinkedIn or Instagram. Please subscribe so you get notifications of when we go live. So you can come and ask questions. We appreciate the chance to discuss, like I mentioned. Just give it a moment to see if any more questions trickle in. All right, looks like that's it. Thanks so much, everybody. Take care.